What's up, guys? Today I wanted to go over my predictions for real estate for 2026. I know I'm a little early, it's September, but there's a reason why I'm doing this because you guys that's been following the market at all, you guys know this is September. The Feds are expected to lower rates. I think they're going to lower rates. I think it's probably going to be I want to say a quarter of a percent, but I'm thinking it's going to be 50%. A lot of people have said, especially on CNBC and a couple of other analysts out there, analysts who look at the market. I mean, nobody really knows. We don't have a crystal ball, but here's what I think. If they lower it a quarter of a percent, it's not going to do enough. So they're going to have to lower it at two more times before December. If they lower it at 50%, they can lower it at 50%. They can lower it one more time during December. And like I said before, the reason why they lower in December, end of the year, is to me is two reasons why. One, it gives the world confidence in our market because people can get out and do spending. Number two, they do it because Jesus is born. All the other holidays from all the other religions are celebrated during that time. And they need people to go out, travel, spend money. They need to stimulate the economy to jumpstart the world come January. So that's why I know that. So if they do the quarter of a percent or they do the 50%, doesn't matter. They're going to do something this month. That's my thought. It's kind of leaning towards that. The problem is with the jobs report, they reassessed the job report, or they lower or adjusted the jobs report, so that actually came down. It wasn't as good as they thought. So there's a concern with the inflation. Everybody that's in the money side, finance side said there's going to be some form of a recession, but I think we already kind of went through a recession, and we see that everywhere you go, gas stations, gas pumps, real estate, the housing market, things have slowed down. I think that is already happening. But here's my reason for saying all that to you guys. Um, number one thing about what I think is going to happen in 2026 as they lower rates. And I was talking to my wife Sharon about this because she's a realtor. She's on the residential side. I'm in the multifamily side for private equity. So I look at institutional quality deals. She actually looks at the actual housing for middle class properties, the average price of houses, things like that, 600, 800,000 because we live in San Diego. So I believe as they lower, and I was talking to her about this because we were talking about the slowdown. More people are going to start buying. Here's the problem with it is that people are like, oh, well, when they lower the interest rates, more buyers are going to flood the market. There's more sellers than buyers right now. But as that equals out, really, when they lower the interest rates, let's say you're going to buy $1 million home. Your $1 million home, let's say your mortgage payment was going to be $5,000, $6,000, or $6,000, $7,000 because of today's interest rates. If they lower the rate, let's say your rate drops down, let's just say five. Let's say your payment went from like 7,000 to 5,000. Hypothetically, just go with me on this number. What's going to happen is the sellers that were in a glut of inventory are going to now raise their price because they can to 1.2 million because that'll offset the interest rate pricing. So it's going to seem like, oh man, the price of housing shot up as the interest rates went up. But really, what people are buying when they buy a home, or they're buying the actual payments, they're buying the interest payments on the deal. That's why you're not going to see a lot of people really wanting to sell if they're at a 2% interest rate. I was talking to my physical therapist the other day, and he's like, I have a 2% rate on my mortgage, so I don't want to do that. I'm better off buying a second home and renting that place out. And I was like, yeah, exactly. Because if you can rent it out and it covers your mortgage payment and you make extra, it's going to eat away the interest payment that you would have done had you done a refinance or sold your home and got a new property at triple what the rate is today. So that was something that I was telling Sharon. I was like, look, if they lower the interest rates, there will be more buyers, yes, but the sellers are going to raise their price to offset the pricing side. So, yes, the values of homes are going to go up, but technically, the buyers are still going to be buying at the same prices where they are. So if jobs don't move, if they don't start increasing the income, increasing the revenue, which I believe that they will, because as they lower the rates, businesses will start hiring more. They can spend more money. They can hire more people. And therefore, jobs and things like that, and the income of the jobs will increase. People can pay more for what they're going to do. But after what just happened, I think people are going to save more. I don't think they're going to spend more. They won't spend more on housing. I think they're going to rent more, which leads me to the next thing. So, the next thing that I know that I believe is going to be happening in for real estate for real estate specifically for 2026 is that and now we're moving into multifamily. The better class of multifamily is going to be the target. Here's why, is because if you've ever heard me talk about real estate investing, things like that, I talk about cycles. the buyer's market phase one and two, and then the seller's market phase one and two. We are now moving into what I consider the seller's market phase two. It is the end of that cycle, but I don't think we're going to hit a bottom. We're going to bypass the buyer's market phase one because I think that bottom was just a stabilization. The Feds did a great job of that. But I think what's going to happen is people are going to start buying again as it relates to multifamily. Buying in multifamily is different because we're looking at institutional quality assets. We're talking about companies buying real estate. We're not talking about people, right? So when I'm looking at a deal, I'm looking at a better quality of asset. Why? Because if the cost of capital comes down, which if the interest rates lower, Feds lower the rates, it's still tied to the 10-year treasury. I think the 10-year treasury was like 4% now, down from 4.3, 4.2, 4.1. It's at 4. Now, if they lower it and treasuries stay where they are, if you just put a 2-point spread on all treasuries, our interest rates will stay at 6. If they come down sub 4, meaning below 4%, the treasury does, it'll still be like a point, 2.5, somewhere in there, or it'll be 2 points still. So it'll still be maybe, let's say our interest rates go down to 5.25, hypothetically. Stick with me. That said, though, somebody's going to have to look at a higher class of asset, meaning like if you're going to, most people like, oh, let's buy C class apartment buildings or B class properties. So that way we can go in, it's called renovate or value add, right? Or you can reposition them, is what we used to call them. And you could fix them up, raise the rents, and then that you have this new value you can refinance. The problem is that we went through years of low interest rates, 2%, 3%. Some people were getting mortgage debt for commercial real estate at like sometimes sub twos. It was crazy. That said, they already did that. They already executed that plan. So a lot of the deals that are still C-class properties based on age have been renovated. So you're now buying a property that all the meat's been, torn off the bone, but you're still trying to think you're going to get a deal there. You're not. The only difference is like housing, the cost of your money to borrow is less. So it's going to feel like you're getting a better deal, but technically you're still getting an older property with the same returns. So I know that was a little bit confusing. So, but this is my prediction. I apologize. But the point of that is this. What's going to happen is the higher quality assets in multifamily are going to be the deals that focus on over the next really 4 years. I think 4 years are going to rock this out. So from 26, all we're going to be focusing on are Class A or Class A assets in a Class A location or Class A location with maybe a Class A minus type property. I'm looking for newer, nicer properties that are already there. And there's a reason why, and I'll go over that in a little bit. But if you're in the multifamily space like myself, where you're in private equity real estate, where you're looking to acquire multifamily real estate, you're investing with us in Bell Capital. This is my prediction. We are going to go after the nicest quality assets, the nicest locations in top cities, because this is going to be the time to focus on those things because there's going to be access to those deals. But if we focus on the old strategy, which is what I was alluding to, with by us not being in moving past the buyer's market phase one, that's where you get rock bottom prices at something, you fix them up. And then if you're going to exit at the phase two of that cycle, then you're going to kind of get your premium out of that deal, but you're going to roll it into the next deal. That cycle is going to get skipped. So you're going to have to skip the cycle and get a better class of asset. Less work's going to need to be done. This is going to be the time that if you don't understand debt, if you don't understand financial engineering, if you don't understand NOI or how to actually manage a property that is already in a great location, in a great situation, and your client base or your tenants, your residents are a higher class of tenant, you're going to have a tough time, right? You really are, because the deals are nice, the people can afford it, the income is there. They have now a choice, renting by choice, as opposed to buying a home. They don't have to, because the prices, like I said, are going to be up there, and they're going to consider, hey, I don't want to have to fork over the money for this payment. I can spend 3,000, 2,000, 5,000 sometimes for my rent and get all of the amenities of this home, but the apartments, the communities, because they're nicer, that I will not get in a house. And I don't want to play the game that just went down last time. I'm just over it. I'm not trying to do that. So I think that's what's going to be happening. So number one, housing prices are going to shoot up, but people are going to be really chasing the payments. So as you're looking at pricing, oh, the price is skyrocketed. Really, when people buy, they're buying based on their payment structure. That's really the target. Number two, same thing with the housing for multifamily for us. We're looking at a higher class of asset because the debt's going to be cheaper, because our payment's going to be a little bit less, but the quality of asset is going to be was going to be a vital selection for us. because we know that we can get that deal. We can sit on that deal 5, 7, 10 years for my investors, and we can actually make the returns that the same returns that we would have gotten had we got a deal that was a heavy value add deal. That's going to happen in 2026. So you put your focus on better quality assets is what I was trying to get to. Next, in 2026 is going to set the tone for this rental explosion for 2027 because there's a supply and demand issue. All the builders, merchant builders who built in 25 completed their projects. They came to market, thought the debt was going to, dark market was going to go down. So they were either going to take a hit on their exit, meaning like the buyers are going to, the cost of capital was more expensive. So they didn't come in and offer in at pricing that they budgeted for at the end. And they've been sitting on this asset. So I think now what's going to happen in 2026, they're going to finally be able to exit some of these deals. They're going to have to because it's just sitting on their books. And there's going to be a glut of rental inventory. Austin, Texas, in Austin and Texas, Houston, that's still going to be happening. Some places in Florida, we see that happening right now, like Miami. You hear all the developers that come in and building the high end stuff's not getting hurt. Like I said, it's the just below high end luxury. These really nice condos that's sitting on the market. The multifamily real estate that's got developed in like some of these other markets that people ran to when the interest rates were low, Tennessee, like all of those other markets, that stuff is gonna finally start to be absorbed in 26. But the thing about when people buy brand new assets, especially something that's been new, typically a lender wants to see 85% stabilization in those deals. And if you are the first owner outside of the developer selling it, you have to have some type of strong management come into play, stabilize those assets. If you're the first owner, maybe they'll put in some controls in place within year 1 and 2 or whatever the case may be for the new person. So as those rents burn, it's called a rent concession. They lower rents to get people in to stabilize the property at a certain time, and they just do what they do. As the rent concessions burn off in year 1, those new tenants have this new rental hike, and they can move. So it may be stabilized to get people in at 85%, but then when the new rent takes place, those people move. So some people are going to move out. They're not going to take the, hey, you have this move in special, well, it's $500 less if you move in today, and then at the end of your lease term, that $500 is now applicable because that's the new rental amount. They knew that, but it was a new place. They moved out, they're transitioned. So as that thing happens, you're going to have this 2026 rents they're flat now, right? In a lot of different markets in 25. Moving into 26, they're going to flatten out, start to rise a little bit. 2027, all of the inventory that got bought that's been stabilized, the rent concessions burned off, the new rents are in place. There's not going to be a lot of heavy inventory coming on the market in 2027. So there's going to be a supply demand issue for rentals. That's my thought. So reason why I bring all that up, because if you buy something in 26, nice, new, you know that your rents are going to be flat, you're going to underwrite it to have a little bit of a dip. If they're at 90, like for example, San Diego, some of the brand new stuff is already at 95% leased. So when those people move in, it gets stabilized, it gets bought this year. In 2026 or so, it's going to dip a little bit, and then inventory is going to dip. So people aren't going to have a lot of good places to move, so they may stay. And then in 2027, new developers are going to come in. They're going to be applying for new permits. Some stuff is going to finally be built and pushing out. And then that way, the rents are going to start taking off again. So, number one, housing prices will go up because people will buy based on their income coming. So, sellers will have the opportunity to raise their price. It's going to cause a discrepancy. Number two, with more deals now coming on the market, the Class A properties and the Class A locations are going to be the better buy because those Class A properties, their rent are still affordable because they're stable right now, and they have been stable for a long time, sometimes soft in certain markets. Number three, there's going to be a rental spike in 2027, but that means you got to have something in 2026. It needs to be nice. It needs to already be kind of be able to compete with some of the new product that may come on in 2027 because they will do the rental the rental concessions to try to get people to fill those things up. And you know you need to be able to compete, and you can't compete if you don't have a great location with some of the new product that's coming on the market. All right. So how do I handle that? Long, long, long. So the way that I plan on taking advantage of that, number one, I think this is a huge opportunity to do that. Number one, There's 500 and where I wrote it down, $525 billion worth of commercial debt maturing in this market between now and 2029. That means there's going to be amazing opportunity to take advantage of those things. Two things are going to happen in multifamily space. Groups are going to have to exit their deal by selling, or they're going to refinance those things. And when they refinance that capital, they're going to pay their investors back. They're going to have some capital. Then they're going to have to redistribute that capital back out into the market. So there is going to be a flood of capital back towards that industry, multifamily. So there's going to be buyers, there's going to be competition. All those things matter. But because of the inventory based on the maturity, somebody's going to take advantage of properties. And I'm going to explain this to you why this makes sense. Because when you have a property that has no equity, you have to sell your good stuff because that's the one that has the money, right? You have to sell the good stuff to make money to whereas it covers some loss or some balance sheet deficit, problem that you have. So as these debts come and they mature and they have to sell or they have to refinance, a quarter of a percent, 50% off of an interest rate on $100 million worth of debt in a company that has a portfolio, or $200 million or $1 billion worth of debt on your portfolio, does zero opportunity for you to go off and refinance. It becomes financial engineering at this point. So, like I said, my goal, how we plan on taking advantage of this at Bell Capital, why we see it as an opportunity, because when that glut hits the market, we're going to get the opportunity to play. All right. Everybody's going to be moving off the sidelines, piling back onto the playing field, and we're going to be one of those people. So, number one thing that we're looking at when we're looking at deals for 2026, my prediction is location. We want to have the best location we can buy because we're going to be in that location for 5, 7, 10 years with our investors. And we want to make sure to play the long game here because the best location always wins, period. All right. Best location always gets the best leverage. Fannie Mae, Freddie, life insurance companies, debt funds, they all want to put their money in the location. The assets can be changed, but the locations cannot. All right. So that's number one. Number two, we're looking at deals that cash flow. Some of these newer properties will cash flow. 1000%. They'll cash flow for the next buyer, especially as the debt market comes down and these people have to exit. It didn't cash flow for them, but it'll cash flow for a new person if they structure the deal correctly. All right. Number three, we're looking for places that we know that we can get a natural rent increase. So what I was just saying earlier. Let's say there's a newer development, or let's say even if somebody bought something 5 years ago, let's say it's a 5-year-old property because we look at those all the time. But we know that there's a rent increase that can come naturally there without us going in and fixing stuff because they've been sitting on it. The property itself or the performance of the property is distressed because the increase in the debt that just came about. Now the debt's coming down. They got to get it off their books. Their oxygen tanks almost empty, and we go, boom, we can get it. And now we can get a natural lift in the rent increase because we know it's been flat for a long time. We can take advantage of being a new owner, and the rental market is going to continue to rise because the inventory is going to be getting absorbed. And in 2026, 2027, there may be a shortage, and we can play that game. All right. Let's see what else. Affordability. The number one thing that I wanted, the other thing that we're taking advantage of is because if we can get a Class A location, Class A property, and be affordable, right? What's affordable nowadays? So $2,700 a month for rent, that's affordable. $2,100 a month, that's affordable. And some of these locations and some of these brand new assets, some of these deals are still below like $4,000 in some of the key locations where houses around it are trading and selling for 1.5 million, 1.8 million, 1.2 million. Like that's still affordable as it relates to rent in that zip code. So you want to be able to take advantage of that, or we're going to take advantage of that, is knowing that the affordability in the in the Class A location and a Class A asset is what we're looking for in a deal. So we want a natural rent increase or lift because it's affordable, but we still want to be affordable to where we can compete. Because, I'll make a video on this later about the below replacement cost. It is building something now nice that's still affordable does not pencil for any developers in multifamily. They have to build something that's somewhere around 800 to 900,000 a door, depending on the location, and it's going to take 2, 3, 4 years to get that project off the ground. And right now, they can't even get the debt for it. Right? They're going to have to put in more capital and bring in less debt to do it. So that doesn't physically pencil because they have to build and sell and get a return. Period. That's called ROC, return of cost. So typically they're looking for 1% over a stabilized cap rate. I'll go over that later. I know that's a little confusing, but bear with me on that. I bring all that up to say The last piece that we're looking for is multiple exits, period. So if we know we got the best locations, we have natural rent increases that we can go in and say, hey, look, can we increase the rents by 75, $100, $300, $200, whatever that is. And then we know we have the best location, we have the best assets, and we are still affordable even amongst the rent increases. We always know that we can go back to the market and go, we can go to Fannie, we can go to Freddie, we can go to a debt fund, we can go to a life co, we can recapitalize our property because as they start to lower rates, as the inventory starts to get absorbed, this glut, as maturities start to happen, they're going to recycle things out. And I think what's going to happen, especially in 2026, lenders are going to be more interested in somebody that has experience and a better plan that is already budgeting for what we said now. Like, how do we do this? Because we don't want to have this happen again in a couple of years. Let's say hell goes to this thing goes to hell in a handbasket, and all of a sudden we're looking at, okay, housing spiked, recession hit, job losses went nuts, and the feds have to go and ratchet down again and raise rates a little bit. God forbid, right? Like, who knows what's going to happen? Like, wars can break out, tornadoes, hurricanes, fires. It's all happened already. We've already seen it. So, what will happen in that situation is we want to be in a good place to be like, hey, how do we exit? And I think the lenders are going to be looking at somebody that has already seen what just happened and they're new, not new to real estate, but new to the market, that their plan has already underwritten and budgeted for this new environment that could take place based on what we just saw over the last few years since COVID. All right. So that's my projection. Number one, housing prices will go up. Buyers will show up because they can afford it. Sellers will get the opportunity to raise their price, so they will get a little bit more money, right? Rents will continue to do what they're doing. Right now, they're slow. People aren't able to raise their rents. A lot of people won't raise their rents because they don't want to lose a tenant because they don't know what they're going to do if they do, right? This is going to be a great opportunity for a lot of people, but you got to invest in location. You got to invest in affordable rents if you're in multifamily. You got to know that you have multiple exits, and you got to get a better class of asset. Don't go down in this next market cycle. You need to go up in asset class, up in location, and you're going to have to play up. Kind of like I tell my kids, if you're in football, sometimes you got to play up to a tougher team and it makes you rise to the occasion. Or when I was doing MMA, we had what's called feeder fights, right? So like you'll take a fight with somebody you know you can beat, gives you confidence, and the guy that you beat sometimes might beat you and that gives him confidence. So sometimes you got to take that feeder fight where, well, if I play up and I win, I dominate over my career. If I play up and I don't win, I wasn't expected to win here, but I was expected to learn something. So I got the experience and people will continue to let me play this game. Like that's the game that's going to be coming up for 2026. But here's what I can say to you. If you're going to be an investor, you're going to do your own deals, get a better class of asset, play the long game as it relates to your real estate investing and take care of your investors because that's what we're doing. If you're going to invest with somebody else, invest with somebody like myself or somebody else who's like, hey, look, we're going in a better class of asset over this next cycle. So we're going to get the benefits of the long ride over here because this will be a long ride and this will be to the benefit of everybody. I wish I would have done this years ago, but I just didn't know. Right. This is what we see. So that's my prediction for 2026. I know this is long. I kind of went into 27 and all the way to 29 with the, but it doesn't matter. So I hope this helps you. I really do. But leave it in the comments. What do you think? Do you think housing pricing is going to go up because people are going to buy? Probably. Do you think rents that are now soft in really nice places are going to continue to rise up over the next few years based on the interest rates dropping and you'll get access to better class of assets? Do you think that? Or are you just going to spectate this cycle through, man, and do nothing? I can say that is the worst place to be. You can't always be in the stands watching the game. Sometimes you got to walk back onto the field. That's what we've been doing, building relationships with you guys, brokers, lenders, property management companies, insurance companies, all of the players of this game so that way we can do what we need to do and be great for our investors. All right. So I'm here to help you. Go to bell-capital.com. You can schedule a call, talk to one of us if you're interested in investing with us, find out how it works. Or you can go to bell-capital.com, hit get started or invest now or whatever that link is there. And you can take a look at our open fund, how you can get going. You got to be accredited. You got to love real estate. This is a long-term investment and you got to have a great attitude. That's the people who invest with us. All right. So I'm here to help you. Let's go. Give it a like, a thumbs up, or give it a thumbs down. Don't be a hater and a hider, but leave me a comment. I appreciate you guys. Have a great day today. Let's get after it. And boom.